Hello, this is John Kvale, and this is our February capital market, most importantly, capital market and financial planning review. It's a Sunday morning, about 24 hours before this will post, so pardon the casualness, but I felt like getting this to you was more important than aesthetics. So here we go. Here is the post, and I'm going to go light on the financial planning, so we can talk about the capital markets, but I did want to mention one neat thing. And that is we have gotten some new features on our blog post here, and we're able to embed our videos. And we still will put them on our YouTube channel, so we'll still have all of those. But we're hoping that'll make it a little more seamless and a little less commercially. Okay, on to the financial planning tips, and that is we did a 3-part abbreviated series. This is going to come out in the newsletter. Another reason why I'm going to kind of go a little bit quicker over this. Those of you that are in listen mode and maybe driving your car, keep your hands on your wheel. I always say that. Those that are listening, the Q2 newsletter article has an elongated version of the ETFs. Basically, it's how they started, when it started, the SPY is the original one, then the growth of it, and then now what to avoid. And it's interesting, as I was working on this article, the capital markets were very calm. And the main thing that I mentioned in this article is these things work great. Some of these the dangers are, I'll let the cat out of the bag. The dangers are that basically you end up with a instantaneously saleable instrument that the underlying assets are not liquid. And that can create net asset value wide differences between what the actual value is and what you're selling it. And that's what I said. These things work great until stress, and then all of a sudden we have a little bit of stress. Okay. All right. On to capital markets comments. I did a post on Friday, and this post is going to go out on Monday. And I had a lot of good comments, and so this is a little bit more of a follow-up on it. So the capital markets, you guys know, the longtime followers know that I love sayings. Capital markets go up on an escalator and down on an elevator. Actually, I could say even go up even slower than an escalator because I've been on some fast escalators. I don't know why it does this, but I'm going to do some research on it. It's always been that way, but it's been even exaggerated more. So let's take this into context. As of, again, this is Sunday morning, the day before, this is March 1st when I'm doing this. I've done copious research and checked all of the sources that I can get, and some of these you just can't be accurate. But according to the Center for Disease Control, CDC, 60 million people in the U.S. approximately 60 million people have contracted the flu this season, and so far 14,000 people have died. I know that's very unfortunate, but I want to put it in the context of the coronavirus. So far, there are 22 people in the United States that have, and that may, by the time this hits us tomorrow, this may have changed. And unfortunately, horribly, we've had one death. That was a late 50s woman who was on the West Coast and did have an immunity deficiency. I'm not making excuses here. This is a big deal anytime someone passes away, but let's think about the context. Something else that I threw in here as I was working on this. While this has been a big move, capital markets are really back where they were in October. They got there fast. It took them basically 4 or 5 days, hence the elevator down. So let's talk about it a little bit more. What's going on? Markets just ignored this. And this is a softer chart. I had another chart, but honestly, there's been so much drama around this. This is the S&P, the Dow Jones, and the Russell 2K. Russell 2K is a small cap stocks. More generally, they have more volatility, and we call there's fancy words for it, but they're all acting like they should. We're pretty much all acting not like they should. They're acting. They're all acting together. Let's say that. We can argue, and I would argue that there was an underreaction when this first came out. And now we have an overreaction. Again, I'm going to do some more research and probably over the summer bring in some neat things on the post Friday, and I may put a link onto it. I went back and just looked at basically 87 was decades ago, and that was the really the first time we had something like this. And these things are coming around more and more. These pullbacks. Those of you that are listening, I'm on a chart that's just showing year to date. These are year to date returns, and we're underwater now year to date. But so since the start of 2020, most equity-like investments are now down a little bit, and you can see the differences here, but down to where they were in October. I think we underestimated what was going on, and then now they're likely overestimating. It does make some sense that when you close, use the Chinatown where this started, when you close a town that has both American companies and Chinese companies in it of 11 million people, you're going to cause an economic slowdown. It's just going to happen. It can happen. So, all right, hold tight, basically, and that's what I mentioned on Friday. One other thing before we leave this. These things, as the faster they fall, the faster they've rebounded. I'm not guaranteeing that's going to happen. Again, I mentioned that on Friday, but these flash moves of 4 or 5 days generally bounce back. Okay, so now or have bounced back in the past? What's something else that maybe we can take advantage of? I'm going to remind everybody, and I'm going to put out an individual post on this. This is a 10-year Treasury. What happens here is when people in the equity markets, fast money, institutional money, real quick money that gets scared, it runs to bonds. The 10-year is kind of the stately bond instrument that people like to go to. People ran, and that could be around the world as well. You have pressure in other countries. You're generally going to go to the safest. You may want to go to the safest bond, and that would, by many people's estimates, present party included, would be the United States 10-year Treasury. So people run to it, they buy it, it pushes the value of the bond up and the interest rate down. These bonds are loosely correlated with mortgage loans. Okay, I'm probably going to take this chance of a lifetime out, or at least maybe calm it down. The mortgage rates are going to come down. I've done some checking over the weekend. They haven't come down as fast as this is, as this rate has. I mean, literally, this rate has dropped very dramatically. This is a long chart, but this move here is to an all-time low. Just giving us to kind of get your ducks in a row and get ready. If you have any especially long-dated fixed-rate loans of any type, now's the time to start shopping. I wouldn't pull the trigger yet because they probably don't reflect the full move. But there's a glass is half full. Hey, here's an advantage that we can take. Again, I will likely do another post on this, and I just wanted to kind of give you the thoughts on the capital markets. They've been. And everybody knows as a firm we are a conservative. We're conservative because of this, but we still want to address it. So a more serious post. I apologize. I think it's because of the latest movement. Those of you that are listening, I'm scrolling back to the top of this post. More serious post, but I think it's timely. I think this is the time that I wanted to really tell you about what I think. Capital markets underreacted. Then they have likely overreacted. It would not surprise us at all to see, I don't think this will just vanish overnight, but it wouldn't surprise us to see basically an easing of the financial markets blood pressure. So I hope this is helpful. Again, a little bit more serious post, but I thought it was timely. Thank you very much, and have a good day, and I appreciate you hanging with me. This got a little bit longer. So have a great day, and we'll talk to you at the end of the March at the latest.